Well, let's get back to the markets here because we are seeing a mixed picture today, but we have seen the Magnificent Seven get hit hard as of late. Nvidia, Apple, Meta, and Tesla, they're all trading down today. Should investors be worried about the pullback in tech and broader ramifications of that? For more, we want to welcome in Binky Chadha, Deutsche Bank Chief Global Strategist. Binky, it's great to see you. So we've talked to a lot of investors recently about the broadening of the rally. And yet, with the big cap tech down today, it does seem to be taking stocks down along with them. So how far can that broadening go, and can it happen without big tech?
For the rally to broaden, so to speak, what you need basically, in our view, is greater confidence really in the cyclical strength of the U.S. economy. I would say, one of the key reasons why mega cap growth and tech have led, especially on a relative basis, is simply, what we call the cyclical overhang. I mean, for the last year and a half, the macro consensus has really been for growth to fall off a cliff, for the economy to go into a recession. So there's very little confidence, I would argue. But I would point out that that does seem to be changing. What you're starting to see is CEO confidence pick up on the economy, and that should get reflected basically in better guidance as we go forward. And the better guidance would, of course, at the same time be associated with upgrades to earnings estimates. So the cyclical overhang is still there. It's still lingering. The S&P at the market level, it doesn't look like it's pricing in a recession. It's pricing in growth. There's no doubt about that. But I would argue there's plenty of pockets within where the market still believes a much more negative outcome, and that would really be in the cyclical parts of the consumer. It would be in the banks, and that's exactly where we belong. Yeah.
And Binky, I want to get your take on another subject, which is a source of debate, which is just valuation, Binky, and get your take, how you're thinking about valuation for the market, and also, Binky, whether it really matters for returns in the near to intermediate term.
So what I would say is, first of all, where are valuations? I would characterize valuations at the market level as basically being pretty full. I would argue that they're not necessarily extreme or hugely overvalued. What I would keep in mind is basically that just think about the S&P 500 multiple going back 100 years, and you see that it basically generally remains between 10 and 20. And then you look at the times that we were above 20, which is where we are today, and you will notice that most of the time when we went above 20, outside of the late 1990s, was when we were having a cyclical recovery. So, for example, coming out of a recession. So that's just simply saying that the market's pricing in basically, some kind of recovery going forward. So valuations are pretty full in the sense that at 22 or 23 times the earnings, the market is pricing in good 10, 15% earnings growth. Now, our forecast happens to be around 10%. So, that's why I say valuations are pretty full, but they're not extreme. In terms of when valuations matter, it's really a function of the catalyst rather than valuation by itself being a driver, especially at these kinds of levels, which are way below where we were in the 90s, for example.
So, Binky, do you think that, we've been seeing a little bit more rockiness in stocks broadly as of late, although then they seem to achieve new records every time. Do you think we'll see a more significant pullback in the short term? And if so, would you be a buyer of that pullback?
So what I would argue, first of all, I would point out that, the market's had difficulty since, October, selling off by 2%. Our technical characterization basically of the pullback is 3 to 5%. Those kind of pullbacks are very frequent. We haven't had one for basically 4 months. The rally has been very, very strong. I would point out that basically, if you look from early November till today, the S&P 500's rising in this very, very tight, very strong trend channel that's going up at a little bit over 4%, so 4.2% at a monthly rate. So, we're now in the fifth month of that at an annual rate that's 65%. So it's clearly unsustainable. So we will get a pullback, but I would argue it's still a bit early to get that pullback. I would say closer, sort of, I don't think it's 4 to 6 weeks away. I would say, if you look basically, and going back to your earlier question, basically, over the last few years, I mean, both on the way up and the way down, and then in the rebound, basically, mega cap growth in tech's played really key role. And we think basically that mega cap growth in tech earnings are sort of approaching a crossroads. Whether it happens basically in Q1 earnings or Q2 earnings is open. But if you think about their earnings over the last 20 years, they've been in this basically very, very clear trend channel. Annual rate of increase or rise in their earnings is about 11 to 12%. But they just delivered a 40% year-on-year earnings growth in the fourth quarter. And that's because their earnings, had fallen basically to the bottom of the channel, and we've now moved much closer to the top of the channel. And so, as long as they stay in that channel, and that's our baseline view, then it does imply a pretty significant slowing in their growth. I'm not talking about bad earnings. So being at the top of your trend channel and moving along is as good as it gets. But it does mean that the comps imply that basically growth rates are going to come down. The market is, of course, very, very long there. It's pretty crowded. And going from last quarter's 40% down to their trend rate of growth, it's a long ways down from 40 down to 11 or 12.
Yes, indeed. Venki, thank you so much for your time. Appreciate it.
It's my pleasure. Thank you.